The federal government has lowered the criminal interest rate. Sounds like great news, but what are the unintended consequences? Ted is here. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome to 2025. This is our first episode of the year, and we're going to discuss a change to the Criminal Code of Canada that came into force on January 1st, 2025.
Okay.
Now, you'll remember we did a deep dive on this back on episode 491 a year ago. Remember that?
Right.
Remember
That's
that
when
show?
they started talking about this.
Exactly. I'll put a link in the show notes to that episode, which gives the full background because I want to cover a different take on this today. But here's the short summary. The concept of a criminal interest rate was first introduced, as you know, Section 347 of the Criminal Code of Canada in 1980.
Right.
So here we are, 45 years later, they've changed the law. So effective January 1st, 2025, the maximum interest rate a lender can charge has dropped from a 60% EAR to a 35% APR. So I love governments changing definitions because it makes it sound even better. So explain in simple terms what I'm talking about here.
So APR is the annual percentage rate. So if you're, think of it as simple interest. If I've got a loan for $1,000 and I'm paying 10% interest, then the APR is 10%. I'm going to pay $1,000 in interest.
Simple.
EAR is a little more complicated. It's the effective interest rate. And so what this does is it takes into account compounding. And compounding is one of those wonderful things. If you're earning it, it's good for you. If you're paying it, it's very, very bad.
Yeah, and most loans do not have a one-year term with one payment at the end.
Correct.
They're monthly, they're whatever, and as a result, the EAR becomes different because of the compound.
And the impact of EAR is, of course, if you don't pay, you're paying interest on the interest. It's all rolling forward.
Gets even worse. So, as I said, prior to this change, the maximum interest rate a lender could charge was 60% EAR, which was the equivalent of about 48% APR.
And that's really what we focused on in the show a year ago.
Right, because it doesn't include the compounding. So that has now dropped to 35%. So we've gone from 48% to 35%. Now, as we record this, mortgage rates in Canada are around 5%, give or take, depending on terms and whatever. Car loan rates are somewhere in the sort of 8 to 11 range if you got decent credit.
Depending on promos,
And promos and whatever. Credit card rates, anywhere from 10 to 20%, whatever. So why does it matter that the interest rate has dropped from 48% to 35%? Like, who cares?
Well, so this change has no impact on secured loans or, mainstream loans, car loans, that sort of stuff. What it impacts is all the second and third tier lenders, the people that were already charging you a lot of money because it's a risky loan. Now the government's saying, well, you can't charge as much on those risky loans.
So somebody who was charging 60% EAR can now only charge 35% APR. That's just the way it works.
Yep.
Now, since this is a new year, I want to take this opportunity to raise for the first time this year your favorite topic, which is, of course,
payday loans.
Because the new law also impacts payday loans.
Right.
So what's changed on the payday loan front?
Well, so used to be that payday loan interest charges or the rates they were allowed to charge you were set provincially. This is now setting a federal limit. So an example, we live in Ontario. The provincial limit's $15 on 100 for 2 weeks. Well, this new federal law is it's $14 on 100 over 2 weeks.
Yeah, it's $14 on 100 no matter what the term is. Obviously, a payday loan is always a short term. So in your example, okay, I'm getting a payday loan for 2 weeks, which means I pay it back in 2 weeks. So 15 times 26 payments during a year.
Because there's 26 two-week periods.
26 2 weeks period means you're paying the equivalent of
390% interest.
Because 15 times 26 is 390.
Right.
So you think of the case where I borrow $100, pay it back in 2 weeks, then borrow another 100. So for the whole year, I've got $100 outstanding. I've paid 390% interest. Now, the good news is they're dropping it to $14 on 100.
Right. So that's going to save you $1 every 2 weeks for those 26 weeks. So $364.
364% is the new interest rate. So which you're right, would be $364 over the course of a year on a $100 loan. So that's fantastic. Like this is
26
great.
bucks. That'll buy you a pizza almost.
That's beautiful. So that's the background. Now let's talk about the implications of this.
Right.
And again, I've put a link in the show notes to the previous episode we did where we went through this in a lot of detail. When the federal government announced these changes as part of the Budget Implementation Act of 2023, I'm going to quote, they said that predatory lenders take advantage of some of the most vulnerable people in our communities, including low-income Canadians, newcomers to Canada, and those with limited credit history, often by extending very high interest rate loans.
Right.
I think 390% is a very high interest rate loan. The current criminal interest rate under the criminal code of 60% effective annual rate is now, which is 48%, can trap people in a cycle of debt that they cannot afford or escape. So, do you agree that high interest rate loans can trap people in a cycle of debt they cannot afford or escape?
Oh, certainly. Let's use the payday loan, since I hate them so much, as an even better example of this, because the interest rates are so much higher. So you borrow $100 and you've got to repay it in 2 weeks, but you actually have to repay, well, it'll be $128 now, right?
It would be $114.
Well, you didn't have the money before. It's coming out of your next paycheck, and now you're going to be short that week, so you got to do it again. And you do it again, and you do it again, and you just can't get out from under it. And the more you're borrowing, the harder that gets to be.
And we know this for a fact because when we look at our clients, people who filed a bankruptcy or consumer proposal at Hoyes Michaelis, if they have one payday loan, they have three.
That's right. Well, and we watched this over the years. We tracked it when they first appeared. 20 years ago, it was, well, they're every once in a while. Now they're on just about every person that we see, and it's always multiples.
Yeah, and they're offshore lenders and a whole bunch of stuff.
And the people that are hurt the most, it's the lowest age decile that we look at. So the 25 to 35-year-olds, because they don't qualify for regular credit, they haven't established themselves. And it's the seniors and the pensioners that no longer qualify because they don't have income coming in. It's the people that are at most risk that end up using these products.
Okay, so you agree, and as do I, and I think as does anyone with a brain, that obviously it is the people who are least able to afford it who are getting screwed the most.
Right.
Pretty much that simple. So on the surface, this looks like a great idea. We are lowering the interest rate, which will therefore help the people at the lower end.
Maybe.
I mean, if I'm borrowing money, I want to pay the lowest interest rate possible, and this new rule is aimed at the most vulnerable people. So this sounds fantastic. So what is going to happen in real life then?
Well, so you're now saying to all these people that have built their business around charging these crazy interest rates that you're going to have to charge 25% less. And so the first thing that they're going to do is, well, a certain cohort of the people we've been lending to in the past, we just aren't going to lend to them anymore. The risk is too great. We can't make any money on people at that rate. Yeah,
if I'm collecting 60% interest, okay, that means if half of my loans go bad, but everybody pays for at least a year,
I'm still making money.
Now, if I'm charging 35%, the math just doesn't work.
Right.
So I did some show prep here, some research. Okay, I have my big stack of paper here.
Yep.
The largest publicly traded subprime lender in Canada is a company called GoEasy Limited.
Right. Well, and they actually call their retail outlets Easy Financial.
And they've also got Easy Home, which is another brand as well. So, and the reason I'm using them as the example is I can actually go look up at the numbers because they are a publicly traded company. Mm-hmm. And so why do they call it subprime? Shouldn't they call it way the hell over prime?
So the people that are charged the best possible interest rates are charged prime plus a little bit. Subprime is they're telling you, no, you don't qualify for that. You are subprime.
So it's worse than prime.
That's right.
What they should be saying. Okay. Mm-hmm. So I'm going to quote from their quarter ended September 30th, 2024 financial disclosures, which is the most recent I have as of this moment in time. Quote, net charge-offs in the quarter as a percentage of average gross consumer loans receivable on an annualized basis were 9.2%, up from 8.8% in the same period of 2023, primarily due to a crappy economy and the implementation of tighter collection measures, partially moderated by an increase in the proportion of the consumer loan portfolio secured by hard assets. We're going to come back to that. The company's net charge-off rate was in line with the company's targeted range for 2024 of between 8 and 10%. So what is a net charge-off rate? What are they talking about here?
So their business model is that 8 to 10% of their customers aren't going to be able to pay them. So 1 out of 10 people they're saying isn't going to pay back this debt. We're making our money on the other 9.
And that's why they have to charge such a high rate of interest.
That's certainly the argument that they make.
And I'll put this up on the screen, and I'll put a link again. You can go and look at these numbers for yourself. But their forecast for 2024, and obviously 2024 is now done, but they haven't released their financial statements here the first week of January. But gross consumer loans receivable, $4.6 billion, roughly. Total revenue, $1.55 billion. So the total yield on consumer loans, therefore, is 34%.
Right.
Okay, well, that kind of makes sense because if your interest rate is up in the 40s, then and you got a 10% charge. Okay. Net charge-offs around 9%, so their total operating margin is around 39%. So if we do some simple math here, if the interest rate you can charge drops from 48% to 35%,
right?
If your loan volume remains the same, then that's a decrease in revenue of 27%.
Right.
Okay. And people can play the home game and do the math and make sure I'm doing it right. Now, of course, I'm oversimplifying this because they get revenue not just from interest income, but they've got fees and charges. And
we'll talk about that later.
And they're also not charging the maximum interest rate to every single person.
Right.
But I'm giving you a kind of sense of this here. Now, they know that under their current lending practices, their loan write-offs could be as high as 10%. We just looked at that
their
number.
plan. Yep.
So if they're charging 48%, they're still making money. But if they can only charge 35%, they don't make as much money.
Again, so now what they're netting out now is somewhere around 35% after their write-offs, and so they're going to end up netting out 25%.
And this is like a few $100 million when you're a $1 billion company.
And that's a 33% reduction on what they were making before.
It's big dollars.
Yeah.
So here's the interesting point. EasyGo is projecting increased loan volume and revenue in 2025 and 2026. So they know about these new rules. Why is it they expect their profit and loan volume to increase?
Well, so they're going to attract more customers, people that they wouldn't have attracted before because the interest rate now is lower.
So they're going to change their business model. They're going to do some tweaking. So now I agree. I think that all makes sense. I think there's more to it than that. You and I are both CPAs, chartered accountants.
Right.
We know that there are only two ways to increase your profit. You got to raise your income
or reduce your expenses
or lower your expenses. There's like no other way to do it.
Right.
So this is, of course, the same for individuals that we talk to all the time. Every single person you meet with, you go, well, is there any way you can increase your income?
It's the same for everybody, everything, right?
Yeah, it's math. So and we say to people, well, can you get a part-time job? Can you get a raise at work some overtime? Or to lower your expenses, can you get a roommate, move to a cheaper place, whatever. So this is the same thing that people and corporations go through. It doesn't change. So, okay, here we get into the fun part of the show. And this is why I wanted to do this show. This is the dubious speculation part of the show. The rest of this podcast will not be based on fact.
Right. This is just us shooting in the dark.
We're just making this stuff up, okay? So I don't want anyone putting a note in the comments, well, that's not true. Well, I'm telling you it's not true, okay? We are making this up. But what I want to do...
It could be true.
It could be true. So I want to think this through. And again, I want the viewer to play the home game here. If you are a high interest lender and you know that the amount you can charge on a loan has dropped by over 25%, and you know that maybe your loan volume is actually going to drop because you said that there's a certain segment that we're not going to loan to you anymore.
Correct.
Can't do it. So what can you do to either increase your income or lower your expenses?
Right.
So Ted and I went off on a quest over the holidays for 3 weeks. We locked ourselves in a room and we thought about this. What can we do? What can we do? If we were a high interest lender, what could we do?
So let's do the easy half first then.
So let's start with expenses.
Expenses, right. Okay. So a B lender's not a bank, right? They don't have other sources of income. So if they need to raise capital, if they need to lend more money, they've got to raise more capital. It means they got to get people to invest.
Yeah, and this is a key point. So when you go to Bank ABC, you have a savings account there, and the bank is somebody does, and the bank is taking the money you deposit on the bank and loaning it to somebody else.
Right.
But when we talk about these B lenders, and we can mention their names because I already mentioned one of them.
Right.
Easy Financial, Fairstone. Who are the other ones?
Well, those are the two biggest.
City Financial, do they still exist?
Not
or
really.
They changed their name to something else?
Wells Fargo.
Wells Fargo, yeah. There's a bunch. Well, I guess Wells Fargo is in the U.S. a bank.
Right.
They don't take deposits.
Right.
So how are they lending out money? Well, they have to go and borrow it.
Somebody has to give them money to make available to lend out to customers.
And in fact, we know that EasyGo borrowed $200 million U.S. funds in July 2024 at an effective interest rate of 6.38%. So one of their things is we got to borrow as much as we can to lock in what we can
to get the best terms.
But okay, so speculation here. Why not, if you're them, start offering savings accounts?
Just becomes more complicated, but maybe.
And I don't know if they're allowed to or not. Again, we're making
well, in the
stuff
U.S.,
up here.
in addition to banks, they have savings and loans. So there are ways to do it. I don't know that you can do it in Canada.
Well, Canada,
there's always a way to do something.
Canada Trust was a trust company before
Right.
TD acquired them. We've got credit unions and so on.
Right.
Could they partner up with somebody who's
Sure.
able to take them? I don't know. So there's my first thought. Could they start taking on deposits? Now, there is a company that you've heard of, Wealthsimple, which is an investment company. If you've got over $500,000 in assets, then you can put money into a savings account that earns almost 4%. Now, those rates have been coming down, obviously, over the
Right.
last year. So could a B lender do the same? I don't know. Maybe. I'm just throwing it out there. I don't know.
Right.
Okay. The other obvious cost that every
Sure.
business has,
So you close your physical locations.
bricks and mortar.
Right.
So, and every bank has been doing this
Yep.
since 2020.
Well, all the bank's hours are shorter now than
Yeah.
they used to be.
Yeah. And it's like, well, here's the app.
Mm-hmm.
Go online and do it. So very few people, other than probably seniors, go to a bank to pay their hydro bill.
Right.
You go online, you do it, you push the buttons, automatic payment, whatever. And that saves a huge amount of money. Banks can have fewer branches. Now, every payday loan, well, not every, the big payday loan companies all have branches, lots
Right.
of them.
Yep.
A couple hundred branches, whatever. Those are costly. If they could do it all online,
Right.
huge savings. I believe the way a lot of them work is they've got the branch. That's where you get your first loan.
And then you just roll them over.
Then you roll them over from there
Yep.
because you got to come in, show your ID, whatever.
Mhm.
So I think that they will continue to increasingly emphasize online lending.
Certainly.
Just makes sense,
Well,
right?
and they'll reduce multiple locations. So, I live in the city of Guelph. I don't know how many cash monies there are in Guelph. I'm sure there's more than one. They'll probably reduce that down to one simple location.
Yeah, there's one here, there's one there, as opposed to one on every street corner.
Right.
And as a result, they can save a chunk of money. I think the third big one will be the greater use of AI, which we're early in the AI world. Maybe it's all going to turn out to be a bunch of hooey. But
Yeah.
I think there's two different ways that they can use it. One is to identify either fraud or funny stuff up front.
Mm-hmm.
So, okay, you go in to apply for the loan and we know you're this old, this is where you live, we got a whole bunch of data on you. So is it reasonable to expect that your income is also this number? Like they can do a bunch of AI stuff on that. And then obviously AI can assist in the collection process too.
And the automated contacting you and
Well, and they've always had robo-dialers.
Right.
They have now gone much further than that in that there are a number of places that the AI is calling you.
Yep.
Hi, Ted. This is Joe, the digital assistant for so-and-so collections. You didn't make your payment last week. Let's talk about making a payment. And you actually have a conversation with it. And at the end, it says, okay, I'm going to send you a text message with a link to our payment information. You click on that, send your money. Boom. So there's a bunch of things they can do to reduce their expenses. Okay, now, the fun part, though, is increasing income.
Right.
So I've got a list of like 500 different things here. I don't think we'll get to all of them. But if you are a lender, what is the most obvious thing you can do to increase your income?
Lend more.
More lending.
Right.
So, okay,
And that could be a higher volume in the products that you have, or you could offer new products.
So the obvious new product would be secured loans.
Right.
Because a payday lender, obviously it's unsecured. But the B lenders that we've talked about are doing installment loans, which could be $5,000, $10,000, but they aren't doing secured loans. So what are the obvious secured loans that they could start thinking about doing?
Yeah, tie somehow into your home equity. So home equity line of credit.
Mortgages, home equity lines of credit.
Yep.
Now, there are companies that specialize in vehicle loans,
That's true.
which I don't know if they're still as prevalent as they used to be, but I can think of one or two companies that's what they did.
Right.
And they call them title loans.
Mm-hmm.
So you have to own a vehicle that doesn't have a loan against it. So I suspect that there's not a whole lot of people who fall into that category.
There aren't. I mean, I've recently seen where the payday lenders are they're advertising auto loans on vehicles that are financed someplace else. I think that's all going to blow up in their face, but
I don't know how they can even do that because it's a second charge on it, obviously.
because it's a trick.
Yeah, it's a trick. Well, and maybe it's a psychological thing that, I have to pay this loan because they'll take my car.
Right.
But that seems a little sketchy to me. What about again, when you and I started in this business back in the 1950s or something, I think, furniture loans.
Yeah, those used to be a thing, right?
They were a huge thing.
Rent-own programs. There's still some out there.
But much less prevalent than they used to be.
Right.
But that would be another, I guess, area. Well, okay, you've got something you can pledge as security. Now, the law has changed in the last 20 years, and
it has.
PPSA, and we're not going to get into all of that. But that would be a potential area that I think we can be watching to see if they get into. Now, higher dollar value installment loans. We're already seeing that.
Right.
This is not new.
Yep.
Right? The payday loan companies all offer longer-term installment loans.
5 years ago, they didn't exist.
And now they're
everywhere.
Thing.
Yep.
And those are subject to the criminal interest rate of 35% now. This is the biggest area that they're going to be hurt in.
Right.
Because that's the higher dollars and bigger numbers. Okay, debt consolidation loans, that's kind of what an installment loan is. Lines of credit. So I believe they do offer lines of credit now.
They do. Whole idea behind approving somebody for a line of credit is that you simply keep tapping into something you've already been approved for, as opposed to going someplace else to get your money.
Gotcha. But the limit of obviously is capped. So,
right.
But yes, I think that's certainly an area we will see more of. What about microfinance products, and specifically products aimed at small business people?
Sure. So your business is small. Maybe it's just yourself or one other person. And so you don't have enough history to qualify to get a bank loan, and you don't need to borrow $20,000, but you do need to borrow $2,500 to get a new computer or a new digital printer or whatever the hell it is. Well, they'll get into financing those for you. A bank doesn't want those. They're too small.
Right. And it's really a personal loan, but it's for business purposes. So maybe they package it a little bit differently and can price it differently or whatever.
Right.
Okay. Now here's my great idea. And I know you think this is crazy, but I'm going to say it anyways. So you're familiar with Costco, right? You ever been there? You know what that is? So Costco is a membership thing. You pay whatever it is, $65, $150, I don't know how much it is per year.
Right.
And you can shop there whenever you want.
Mm-hmm.
So when we've done podcasts on this as well, most of Costco's profit comes from the membership fees. They are basically selling everything at break even.
Yeah, it's a financing.
Well, there's also a financing.
That's right. They get it in the shop immediately. They pay it in 60 days, but they sell it in 30.
Right. So those are their two big sources of income,
model.
Your membership fees and the financing.
Right.
And they have to have stuff in the store or else you wouldn't keep paying the membership fee. And they have to have good prices in the store or else you wouldn't keep coming back.
Right.
But they don't really care if they're making a huge profit on the product or not because it's the membership.
It's not their model. Yep.
A gym membership would be the other obvious one.
Sure.
You've got a gym that can hold 500 people, but you've sold 3,000 memberships because nobody's ever there at the same time.
Nobody's ever there.
Nobody's ever there, yeah. Well, they're all there in January. Everybody's probably listening to this at the gym right now.
Right.
Why not do the same thing as a lender? So here's the deal, Ted.
They could.
I'm Joe the lender. There's a $10 membership fee per month.
Yep.
And for that membership fee, you've got the app and everything, so you can go on. You're already pre-qualified for the different kinds of loans we've got, all the different kinds we've talked about. You've got access to your credit report, which is right there in the thing.
Right.
Maybe there's a whole bunch of other stuff that.
Well, they'll certainly tie into special businesses with promotional material. You know, hey, this is on sale now, and you can finance it through us. That sort of stuff.
Yes, exactly. Yep. That would be the link. So
right.
we make a deal with Staples so that you can buy that new printer you need and finance it through us. So. That's my big worry, that they actually do something like that. Now, I don't know who's going to pay for that.
Somebody will. I'd
have to be getting more than $10 worth of value to do it. But I guess if it costs $25 to get my credit report every month, if I'm paying for the full rate.
People still paying for Credit Karma and Borrowwell?
Those are free,
okay,
but they don't give you your full credit report.
Right.
And they don't allow, they're sort of a backhanded thing. But they could be doing the same kind of thing. Okay, so let's take this a step farther then. So those are kind of loan related stuff. What about, we already talked about savings accounts.
Yep.
Like, why not? Now, none of their customers would be putting money in savings because they don't have any money. They're borrowing.
Yeah.
But if you could attract maybe your customers who've rehabilitated and don't need loans, or new people.
Well, and you're looking for people that are looking for a better rate of return than they get in a bank savings account, but aren't willing to buy your stock and run the risk of getting the returns that way.
Right. And so we already figured out that Go Easy has a effective interest rate of 6.38% on what they're paying. So if they had a savings account that was paying 3%, which is higher than you're getting at most banks, but half what they're paying elsewhere, obviously there's administrative costs and so on. Right. But if it's all done through the app,
might make sense
or whatever, maybe. So we'll see about that. Now, I know you're a big fan of this next one. Insurance.
Right.
So you get your loan insurance, your health insurance. Maybe they could be doing car insurance and all the rest of it.
Right.
You're not a fan of it because they overcharge you and it's a scam.
Right.
But why not? If you're
I mean, we're not doing this as to whether or not you or I would do it. They're saying these are different ways that they could increase their revenue.
Yeah, and the reason we're doing this is so that if they do it, you're going, hey, wait a minute.
Right.
It sounds good, but it really isn't.
Well, and what we really want you to do is anytime you sign a contract with anybody, look to see what all these ancillary fees and charges are for. Mm-hmm. We're just giving you a list of things that we think they could be doing.
Yep. And we're not trying to teach them how to do their business, but I'm pretty sure they're smarter than me. Here's the rest of my list. Bill payment services. Mm-hmm. Okay, I don't know exactly how that would work because you can do it through your bank. But we're talking about, we already said, people who are more vulnerable. Perhaps they don't have a great banking relationship. Perhaps their bank account has been frozen because of their other debts.
And they might do this at a better rate than an overdraft.
Yeah.
So maybe you just automatically tap into it.
Yeah. And it would be an overdraft component, but it would also be, you've got all your bills are right there on the dashboard.
Yeah. But what I'm thinking, so they'd get you approved for a line of credit, your paycheck would go to them every week.
Ooh.
Right? And you just pay it off that way.
I hadn't thought of that, but yes.
That's what you were going for.
See, this is why we had to have this show. But you're right. That would make perfect sense. You've got a quasi bank account at the lender. Your paycheck goes in there, and you can set it up to pay all your bills and loan against it and overdraft and all the rest of it. Ooh, that would be pretty evil. Well, and that ties into things like money transfer services. They could have prepaid debit cards, obviously with fees, foreign exchange, the whole rent-to-own thing, maybe even get into some investment products. And then, of course, the whole credit repair thing.
Right.
Here's a loan that we report to the credit bureau, charge you a high interest rate, but you pay it off and your credit gets better. So those are all, I think, kind of creepy things. And I don't know, maybe they end up having storage lockers and safety deposit box rentals and all the rest of it. So, and why not keep going? You got this membership with us. We've got our job search thing you can sign up for.
Right.
Because the reason you're borrowing from us is you're out of a job.
Yep.
We can help you with that. We got resume writing, skills training.
And we're not tying into any of the data applications. So they're going to have you in their database. And the more of these types of products they sell you, the more information they know about you. So the more focused they can be in redirecting or reselling your name to somebody that wants to buy it.
Yes. Right now, your name is in the database because you got a loan from them.
Right.
But they don't know what your hydro bill is. They don't know where you shop. They don't know where you work. All those other things aren't there. So I agree. Ultimately, that's what this is. This is a data play.
Right.
And so the reason we are doing this discussion is so that you are aware that this may end up happening. And I agree with you. You should be reading every contract you get.
And good luck with that.
And when they offer you these free ancillary services, you got to say to yourself, wait a minute.
Yeah. How is it free? Why is it free? Somebody's got to be paying for this.
What's going on? Mm-hmm. So what you're going to be seeing in the news over the next few weeks, I'm sure, is reports about, hey, the interest rate has gone down, and there'll be some places spinning this as a great victory for the working person.
Right.
Which in some cases it is, I guess. If you are still able to qualify for a loan at a lower interest rate.
Yeah. If you used to be paying 45 and now they can only charge you 35, I guess you're ahead.
Yeah. You're still paying a huge rate of interest, but it's good. And maybe this will make all the rates go down a little bit because, it kind of shifts down. All the rates have come down anyways. So that's, compared to where they were many years ago.
Right.
So the point of this podcast is not to give all of the subprime lenders and payday lenders ideas on how to get more money out of you.
No,
that's not what we're trying to do.
They have more ideas than we do.
Well, exactly. They're way smarter than us. They've already got teams of people working on this. They don't need our help. The point is to give you a heads up on the marketing push that you're going to be subjected to so you can recognize it as it happens and be prepared to respond. That's what this is. This is a heads up. Some of these deals may be great. Most deals will probably cost you a bunch of money. Do you really want to pay a monthly fee? Probably not. So any final thoughts on any of that? I mean, basically, it's just buyer beware. That's
always what it comes back to. I mean, you can go through and count how many times in the show we've said the only person that's really interested in your financial health is you. Everybody else is trying to make a buck off you somehow.
So if it seems too good to be true, it probably is. And if it's free or really low cost, you're probably the product that's being sold.
Right.
So be aware. Maybe they'll have this membership club that I'm describing, and it'll be free and it'll sound really great.
It'll come with a T-shirt. We'll all be wearing
exactly. But I agree with you. It is a data play. So that's our message. Just be careful. That is our show for today, our first show of the year. I'll put links in the show notes on YouTube and all the podcasting platforms to everything we talked about today. If you're watching on YouTube, please like, subscribe, click the notification bell so that you are notified of all new podcasts. Same on all the audio platforms, Spotify, Apple Podcasts. There's 50 others. We're all on them. We have a new episode every Saturday morning. I know you get up early to make sure you don't miss it, even though you were on it. Last week was our annual prediction episode, so that's a good one to listen to if you missed it. Next week, Ted and I are going to discuss a topic that's near and dear to my heart, and it'll be a big topic in 2025, which is that a house is not a great investment if you can't afford it.
People always like that show.
Every time we talk about real estate. And again, we're not advocating one position or the other. We're throwing stuff out there so that you can be aware of it. So you'll want to tune in for that. And if you've already gotten yourself into too much debt, well, track us down. We got a company, Hoyes Michaelis, that deals with all of that. So until next week, when we'll talk about real estate and debt, thanks for listening. I'm Doug Hoyes. That was Debt Free in 30. 3140. Well, I know they're all working on all this stuff, so